but for those that were depending on it. Okay, so again, the point is I want to go through this high-level LBO analysis. This is just putting to paper what we've done on the board, and this will allow us to hone in on variables. We're going to do things at the end too, like creating a 2-variable data table. How do we maximize constraints? How do we maximize IRR? So the purpose here is not necessarily how to build a leverage buyout only, but how do you tweak variables to maximize IRR? I think that's the bottom. Yes, Clete. As I was talking to you about not being able to record it, I found the button. So, good. And thank you for that. Okay, so 2 tabs here: assumptions and financials. And again, this is just one small step further from the actual model. And you know what? I'm realizing. Excuse me. I sent you the full-blown. We're not ready for this one yet. I want to do the quick analysis, so hang on to that one. But let me send you a second link for the quick analysis. Sorry. So that full-blown we're going to talk about. What I do want to do on Monday is talk about the differences, and I think, Daniel, if you're on, you kind of hone in on one major difference yesterday. I'm sending you a second link. The differences between a basic leverage buyout and a full scale. And, of course, one of the biggest differences is the idea in the basic leverage buyout. We're just assuming interest expense in 1 year on the debt that we're raising, and we're just keeping that flat each year. And in reality, if you're aggressively paying down debt, as you pay down debt, that interest level is going to decrease. So that's one flaw that these simple analyses don't handle. So in the full-scale buyout model that I sent you just before, we're going to use that and evolve that into the acquisition of Heinz by 3G and Warren Buffett. So first, I want to hone in on where the major variables are. So please let me know that you're getting that second link, and that should look a little bit different. That should be a one-pager. That should look like this. Okay, good. So sorry for that confusion, but hang on to that model. We will be able to utilize it. Okay, this is what I want to lay out, and then we'll evolve into that one. Okay, so if you see this again, I wouldn't really recommend using this in practice per se, but just this is a high-level thought process. This is the way you should be thinking about a leverage buyout if you have a model test. Remember, I mentioned to you guys at the end of the program we're going to start doing cases, and part of the challenge of cases is how do you determine and identify if this should be just a paper-written case, if this should be a model case, and if it should be a model case, how do you know if this should just be a one-pager case or building a full income statement, cash statement, balance sheet? And a lot of times you don't know, and this is where time management comes into play. So a lot of times my recommendation is just get to the answer. Build a simple analysis. Think of it. Think of high level instead of income statement, cash statement, balance sheet. Start getting to the answer as quickly as possible, and then you can start saying, well, I got time. I can actually, instead of making depreciation as a percentage of revenue, I can build the full depreciation schedule and then link that in. And then I can build the full working capital schedule and link that in. So you're starting with a simple model and then slowly growing that model as you realize you might have more time. So that would avoid the common problem in an interview test where you're asked to put together a case and then time's up and then all of a sudden you say, well, I only got to the income statement. That doesn't work. You want to make sure you're getting an answer. So we'll slowly build to that. But my point in explaining all that is this is the way you should be thinking about first, from a first perspective, an LBO case, and then building out areas here where you see fit given the time that you have. So let's always start with the assumptions. And the assumptions here is we're assuming that we're going to pay a 30% premium above the $20 stock price of a company. This is a fictitious company, right? So the way this will work is obviously, and again, you can tell this is a public company, is we're going to take $20 times, open parentheses, 1 plus 30%. Actually paying $26. So if you notice here in the target financials, this is a picture of the company that we're purchasing. Revenue, EBITDA, EBIT, net income, shares. Note, this is really all we need to do a leverage buyout analysis. I think you can get that from the examples that we've done on the board already. You really just kind of need EBIT, some measure of cash flow or built to some measure of cash flow. And so what are the dependents of the unlevered free cash flow statement, right? So we have shares. We're assuming that they're already diluted. It says they're diluted shares, so we're not going to go through the process of diluting shares. We will do that with the Heinz case, though. And so the purchase price is, of course, a product. It's the diluted shares times the price per share. So we are paying $19.5 million for this company. It's a 30% premium. Now the question is that really a premium to its core value, or is it a discount? Remember, with Office Depot, Office Max, they actually paid a discount to the value. And how do we determine that? Well, we compare this with the book value. They paid a discount to the book value. So with the uses with the purchase price, we can pull the purchase price in from 19.5. And transaction fees here are given. We're not going to estimate transaction fees. We will look to that in the Heinz case. And then refinance debt. And of course, remember in this case, because the company is public, we will pay down the net debt, right? In the board cases, or what we've talked about time and time again, is the way the purchase price is obtained will allow us to determine whether we have to pay down the refinance debt or not, right? So when the company is public, we know we have to be responsible for the debt, and maintaining that responsibility depends on if we have to actually raise additional funds to pay down that debt, or if we are allowed to take roll the target debt balances into the acquirer. In a leveraged buyout, you don't roll the debt balances into the acquirer, but you can determine if the debts stay on the balance sheet or not. And that determination depends on, if the company is public, the covenants. Right? We talked about the covenants, the bylaws, the covenants that would state if there's some major company event like a change of control, you would kind of think about, if the covenants state that you have to pay on the debt based on change of control issues, then you are buying the business. That's a change of control issue. You won't have to pay down the debt. So let's assume that that's going to have to happen. So we're going to take the refinance debt, which is going to be the net debt. It's going to be a sum of the long-term debt plus the short-term debt minus the cash. And I'm going to total everything up, 24. So the total uses of cash is 24. Now the sources of cash on the board, we looked at multiples to determine sources of cash. You can also look at percentage of total capital. I think the example on the board yesterday, we said that although the term A loan was raised at 3.5 times EBITDA, the term B loan was 15% of total capital. So you can certainly look at it that way. And in this example, we used percentages. I could have done an EBITDA multiple, but in order for this to be fully flexible, you have to make sure that this is dependent on one and only one variable. So my point is, I want to be able to create a two-variable data table at the end of this analysis that's flexible by purchase premium and by the equity raised, right? So if I want this flexible by equity raised, I need the equity percentage to be the one and only one variable. So if you look at the formula here, I just assumed that 1/7 of the debt will be mezzanine, 2/7 will be high yield, and 4/7 will be debt. And the reason why I did that is so that way, if I change the equity 25, everything else will shift accordingly. If these were all hard codes, the two-variable data table would not work because there would be more than two variables that's supporting this analysis. So I want to make sure that my analysis is supported by two variables just for the purpose of getting my two-variable data table to work. So just note that. That's the reason why I did that. So this is simply the bank debt's going to be 40% times the total capital, right? And so on. The high-yield debt is 20% times total capital, 10% times total capital. And what you guys should be doing, just because I know it's tough to kind of look at this at the same time as working on your own model, you should be having your own model open and building it as I'm talking, and then just flipping back to the screen to be matching numbers. So I'm watching the chat screen. Just note if you have questions, or if you want me to hold off, or if you want me to look at a formula, just type that in quickly. That's the way you should be managing this, in my opinion. Okay, 30% times total uses. You can add everything up, and the uses should match the sources. So you should have 81.60 in bank debt, 40.80 in high yield, etc. And we can use these numbers to back into the EBITDA multiple. So with the EBITDA multiple, it was given. The EBITDA was given at 3,000. I'm going to go in and just take the balances of debts and divide it by the EBITDA. to get the multiples respectively. So it's about a 2.7 times bank debt, which is in the range. I mentioned 2.5 to 3.5 times bank debt is usually what you would receive. And just a rule of thumb, about 3.5 to 4 times total asset-backed capital. So I'm sorry, total debt capital that's not mezzanine. So usually bank debt, term A, term B, high yield would be 3.5 to 4 times. And in this case, the sum of the two is 4.1, so that's pretty much in the range. Mezzanine debt, the 2040 divided by EBITDA. And then equity, although a lot of people don't look at EBITDA multiples for just the equity component, but just so we have it, is 2 times. And the total capital is going to be 6.8. So any questions on that, let me know. All right. So now I want to look at purchase multiples. Purchase multiples is going to help us identify exit multiples. So you'll see where, and we'll talk about this at the end when we're honing in on the variables in a leveraged buyout. And if you recall, we did this with mergers and acquisitions. It's important to understand what are the major variables driving this analysis, and that's going to help you solve a case. So we'll talk about this with the Heinz case. There are tons of variables in a full-scale leveraged buyout model. How do you hone in on the ones that matter? Well, we're going to first look at, from a kind of more general perspective, what are the major variables to focus on? We'll use this as a tool to understand what impacts adjusting those variables have. And then in the Heinz case, we're going to look at how do we adjust those general variables and focus on what of those variables actually matter for Heinz versus what don't. So that's just to give you an idea as to where we're going. I want to record what the purchase multiples are so I can use these to build for my exit multiple. So purchase multiple here is going to be enterprise value, which is a purchase price plus the refinanced debt. Don't make the mistake that a lot of people do and take total uses. Total uses includes transaction fees. We do not want transaction fees. So with this enterprise value, we can calculate EBITDA and EBIT multiples respectively. $6.8 and $7.8. Anyone have questions on that? All right, these other things, the return statistics, we will do when we're at the bottom of the model. The interest and the debt we will do when we're at the bottom of the model. So if you remember the steps to a merger analysis, which is step 1, getting the sources and uses, and then step 2, getting the purchase price, and then step 2, getting the sources and uses. So let me just pull up the slide that reflects that right here. So if you remember, here are the major steps. Steps to really any analysis is purchase price calculation, sources and uses. We had just done that. We had estimated the purchase price. Forget the idea of valuing it, right? So we're going to look at the case, like I mentioned, the last case that we're going to do is determine how do we value the entity appropriately, especially if it's private, and then how do we layer in the leveraged buyout model into our valuation analysis so that we're not wasting time in building 2 different models. How can we do it all in one model? That's the last case challenge we're going to deal with. Sources and uses we had just laid out. Remember, it's what am I paying for, the purchase price, refinancing existing debt, and transaction fees. And remember, don't forget that whether you have to pay down the net debt or not depends on whether the company is public or private. And then if it's public, you want to make sure that you're looking at the covenants to determine if that means that you have to raise additional funds to pay down that debt, or can you keep it on the entity and roll it over. And if the company is private, you want to determine, well, how did you come up with the actual purchase price to determine whether you have to pay down net debt or not. In other words, if the purchase price that you have negotiated is based on some sort of equity value like a PE multiple, that excludes debt. You need to consider debt above and beyond that. If the multiple is an EBITDA multiple, then that's an enterprise value, and that is effectively a purchase price plus net debt. So don't take an enterprise value purchase price and add net debt on top of that. That's a mistake a lot of people make. And just to recap what we're going to next we have to actually perform the LBO. And from a high level, this means getting an exit. and an exit is just a multiple of EBITDA, but it's the year 5 or year 7 or whatever, however far out you're projecting's EBITDA. So if it's a year 5 or year 7 EBITDA, we need to project out EBITDA. So the first thing we want to do is project our EBITDA out 5 years. Take a multiple, multiply by the EBITDA, that gives us our exit, but that's not our return. That's not the money that we're putting in our pocket, because we have to pay down debt, all the debt that we've raised. And in the model we've raised, how much of debt? In the model we've raised 8 plus 4 plus 2. We've raised $14.2 million in debt. So we got to pay that down, but over 5 years of owning the business, a couple things had happened. One, we had incurred interest on that debt, so we need to pay down not just the debt, but the debt and the 5 years of interest. And then two, we've actually generated cash that could pay all that down, or as much of that as possible. So it's important to calculate interest to figure out how much interest would have been generated. And then two, it's also important to kind of quickly estimate how much cash would have been generated in 5 years. So that's why we need to really lay out an unlevered free cash flow analysis. An unlevered free cash flow analysis would give us the cash generated and would also give us projected EBITDA. So really what we want is we want the future EBITDA to calculate the exit. We want the unlevered free cash flow because the cash can pay down the debt. And with the exit and the final debt, we can get a return. And that's how a leverage buyout works. So we're going to now first quickly project out our EBIT. So I'm going to pull in EBIT into 2013. And I'm going to project EBIT out at the year before times 1 plus the 12%. Copy to the right. You should have 4582 in 2018. D&A, all these things, for purposes of this analysis, let's just keep it flat. I don't want to focus on, we've done enough valuation examples where we've projected out EBITDA and CapEx, etc. I want to keep this flat. I just want to illustrate more how this all comes together. Yeah, Robert, we probably could have just taken, it would have been better to take D&A as a percentage of EBIT. If we took CapEx as a percentage of EBIT, then we should have also built a tier D&A schedule. But let's just, my point is not about creating unlevered free cash flow, but how it comes together. Because I do want to move quickly into the case where we will be building all this stuff in a lot of detail. So, point taken. Change in working capital, let's keep this flat. Again, I don't want to get into making projections. We got plenty of classes on making projections. I want to get into the functionality of an LBO. Taxes, we will take EBIT times tax rate. EBIT times tax rate. And we can use this. Oops, I forgot to anchor my reference to the tax rate. As a side note, if anyone knows, my F2 function keys don't work on the Surface because they're reserved for like brightening the screen and darkening the screen. Brian, you're a tech guy. I don't know if you know how can I eliminate the functionality. I have a window of Surface, the Surface functionality, and let F1, F2 to F7 be what they're meant to be in Excel, because I'm so used to doing F2 to look into cells and F4 to anchor, and I can't do that. F4 is like play, pause, and all this stuff that I never use.
You have to download a plugin for it, Paul.
It's a plugin, Brian?
Yeah.
Okay, maybe on Monday if you can let me know. That'd be awesome. Thank you.
Yep,
cool.
No problem.
Yeah, that's been kind of bothering me.
Yeah.
All right. So unlevered free cash flow. Now you could have, and you know when I do this on the board, I'm good about making CapEx a negative and then adding everything up, but and maybe we should do that. So I mean, CapEx should be negative, right? Because that's going to be cash outflow. D&A is positive. Keep the change in working capital positive. Let's assume that's cash coming in, and the taxes are negative. So that what we need to do is just sum everything up, right? So let me just kind of make sure that this works going forward. And so our unlevered free cash flow is a sum of EBIT plus D&A plus CapEx plus change in working capital plus taxes. This is what you should have as unlevered free cash flow. 2013 we don't do. We don't care about that cash. Before the business was sold, that cash, if there is any cash, would have gone to pay down net debt. Maybe the seller would have put it in his pocket. Okay, now we have the basic tools we need to kind of run the LBO analysis. I want to add up how much cash did I generate through the life of the transaction. I'm going to sum all this up. 8,600. Okay, now I want to calculate how much interest has incurred, because what I want to do is I want to say, okay, well, I've generated 8,600 in cash. I know I got to pay down debt and interest. So how much interest has been incurred in total? Let me just go back up to the box here and calculate the actual individual yearly interest on each piece of debt. So the bank debt is 5% of 8160. High yield is 6% of 4080. Mezzanine is 12% of 2040. Right? This is the interest each year, and I'm going to total it. And so it's that interest 5 times. But now interest is tax deductible. So I want to take that interest and multiply it by 1 minus the tax rate. So the total interest incurred, the total interest obligations is going to be equal to the 897.6 times 5 times 1 minus the tax rate. So I'll leave that open. Let me know, guys, if you have questions, things like that. Okay. So I'm the way this box is laid out is a little bit different than the way I explain it on the board and the way I just explained it before. This is another way of looking at it. I would say this might be a little bit more intuitive. The way I did it on the board is more compact. So the way I'm looking at it here, and it's all the same thing, but the way I'm looking at it here is, okay, we've generated 8,600 in cash. First thing I got to pay is my interest. Otherwise, I'm defaulting. Have to pay the interest. The debt, technically, I don't have to pay until the very end, right? So that's the way that I thought about it when putting together the model here. So let me just see, after interest, now how much cash do I have, right? So I subtract, say, okay, I generate 8,600 in cash, pay down the interest. I got 5,907 left over. Now let me see how much debt I can pay. So just another way of looking at it. Again, I think it's just more compact to do it the way I had laid it out this morning. I'm sorry, just before, or how I've been laying it out in class. But it's either way, it's the same math. So what's my total debt obligation? It's the sum of the bank, high yield, and mezzanine. Now, we're going to have a class on mezzanine because Warren Buffett's investing in a quasi kind of mezzanine type of debt. It's a preferred security that has warrants, and we're going to talk about how to model that out. But a basic core type of mezzanine lending in a buyout is it is debt until exit. It is treated as debt, so the investor has the protection of it being debt, and it might come with 5% equity. So upon exit, the lender would get that debt back, and then they get like a 5% equity stake. Now, in this case, let's just assume they're going to get the debt back. We'll model one out more completely with the 5% stake, et cetera, things like that in the Warren Buffett case. Again, here I just want to kind of focus on the mechanics of an LBO in general. So the final debt is, all right, well, I got 14,280 in total debt. How much cash do I have left over? I have 5,907. So let me take the 14 minus the 5. I have 8,373 in final debt. That's the debt that I have to pay down when I exit. Any questions on that? Okay. So now enterprise value, this is my sale price. I have to exit Before I exit, let me figure out what my entry multiple is. Let's assume, as we do as a standard, that the exit multiple will be the entry multiple. So for this EBITDA multiple, I just want to link it in from the enterprise value, the entry multiple, 6.8. I could have hard-coded 6.8, but there might be some rounding difference. I want to use this as my exit multiple. So my exit enterprise value is going to be that 6.8 times my EBITDA. So I'm going to have to do this in parentheses because I need to add my 2018 EBIT plus my D&A. 33,712. And so the exit market value is going to be the enterprise value minus the final debt. That's how much money I get at the end, right? So I sell the company, but I'm responsible for paying down the final debt. The final debt is the beginning debt plus the interest payments minus the cash I've generated. And now I want to calculate the return. So on the board, we've been using the Kager formula. Now we can be a little bit more specific. We can use the IRR formula. The way the IRR formula works, and we'll do a more complex one with the Heinz case, is first we need to understand how much money do we put into the business. So how much money do we put into the business? It's the equity that we raised to fund the deal, not the purchase price. A lot of people could get confused and think it's the purchase price. It's the equity that we put into the business. Exit's 2018, so we're going to link in the exit to the market value that we just analyzed. And then we have to hard code in zeros for this IRR formula to work. It's going to recognize zeros as time. Otherwise, it's going to see if there are no zeros in there, it's going to assume that there's been only 1 year from the 25 to the 6 to 280. And so for the IRR formula, we're going to do equals IRR, open parentheses, highlight the row. 32.86 return. Okay. Usually I do this on the board, but most importantly, 32.86% is a strong IRR. What makes that IRR strong? What are the key variables and components to maximizing an IRR? Another point of view of looking at this, often when I was in private equity interviews, somebody would just, as a final case, instead of making me build a model, which almost was harder in a different way, somebody would show me a model where the IRR kind of was bad. It was like 10%. And they'd say, walk me through this. What's wrong with this? And so for you guys that are used to just putting together templates and understand the LBO mechanics, if you're not stepping back and thinking about the variables, that's hard to analyze. That's hard to analyze quickly, and that's hard to hone in on what are the drivers. So I'm going to kind of ask you guys to speak up, and I want to walk through what are the major variables. What can you tell me are the major variables? And let's see, just so we can have it, I'm going to type it in here. Key variables in an LBO analysis. Where do you begin? This is going to be the way you should be thinking about an LBO case. What's one key variable?
Hey, Paul. The company's debt levels.
AJ, yeah? Is that AJ? Okay.
Yeah.
Companies' levels of debt. Yes, in the sources. I'm going to lower that, though. Absolutely, debt. What else? I want to try to be as organized with timing as possible.
How much you're paying for the company?
Say it again?
What your equity stake is?
You said equity?
Yes.
Yeah. Equity, yes. Equity is reliant on the debt. I'm going to put debt. I'm going to put the debt / equity mix on the same line of variables. What else? EBITDA growth. Okay. I'm going to move that down even further. Make sure you're thinking about the variables in order. We're going to talk about, it's really important, obviously the key part of the case is not only, I can't get my number 2 going, it keeps giving me percentages, is not only how do you solve the answer, but what is your thought process? And are you thinking about the LBOs and the variables in the proper framework? So, okay, EBITDA growth is a bit of a different category though. Whoops. What else? Yeah.
Would it be your premium you're paying?
Yes, purchase price. Thank you. The purchase price is the first key variable and what it's dependent on. If it's a variable based on comps, are your comps accurate? If it's the premium that you're paying on the purchase price, is the premium accurate? Right? How are your negotiations going? Then it's the debt equity. So if you actually think about a deal process, right, the first thing you want to do is you're negotiating with the seller. You're saying, well, what is this company really worth? I want to negotiate the purchase price. That's the biggest key variable. As you get and hone in on a range of purchase price, and you know, well, I'm going to be paying $20 million versus $25 million. Once you start to hone on a purchase price, then you're negotiating with lenders. And that's when you get to number 2. Then you're starting to think, okay, well, how much debt can I get? What's my minimum equity I can pay? What else? So getting back to the slides and the steps, this is how you should be thinking about variables. 1, purchase price. 2, sources and uses. What else about the sources and uses are dependent on variables? What do you guys think? Yes. Thanks, Daniel. Interest. Right? So debt equity. 3, interest. Interest on the levels of debt. What else? I'm thinking of one more. Anybody? Somebody? Nobody?
EBIT growth?
EBITDA growth we got there. EBITDA growth Robert mentioned. Not quite yet. One more on the sources and uses. Let's do that.
We'd be looking at cost of capital.
Well, cost of capital is kind of more of an output. And Robert, yes, good point. We'll talk about how each of these impact the IR in a second. I'm thinking about fees, right? I want to just look to the uses, right? The purchase price, fees. What else? What else in that vein? Aside from fees, I'll actually move fees down here. There's one I would argue in a little bit higher priority. Anybody? Somebody. Yes, the net debt. The net debt of the target company, whether you have to pay it down or not. Should you refinance it? Right? And this is where we'll get to when we look at the case, the due diligence process, the process that you guys don't really see because that's kind of the later stage of the deal and kind of done by bankers, lawyers, and things like that. A lot of people have to do diligence on the target company's existing debt. Right? What's the rate on the debt? Should you refinance that debt? Do you have to pay it down? Okay, so again, you're thinking about this is the purchase price, how the purchase price is obtained, and this is the sources, uses. Right? Sources of cash, how much debt can I raise? What the interest on that debt is? What's it all used for? The purchase price, of course, the net debt, and the fees. Once we establish what we have to pay for in total, and actually I should probably move net debt and fees up when thinking about that. Once you've established what you have to pay for in total, right, purchase price, net debt, fees, and once you know how you're going to fund that, next the challenge becomes your EBITDA improvements, EBITDA growth, right? Are you achieving your EBITDA growth estimates that you'd set out to achieve in order to get that exit? What else? What are other variables? Anybody? Well, yeah, entry, exit multiple. So entry multiple we discussed, kind of covered in along with the purchase price. Exit multiple, yes. Exit multiple is going to be the very last thing, though. What else? Multiple. M-U-L-T-I-P-L-E. Exit multiple. What else? What else kind of in line with EBITDA growth? Nobody? Yeah. Okay. CapEx. D&A. Working capital. Anything related to cash flow. So I'm going to say unlevered free cash flow generation. Anything else? I mean, EBITDA, yes. EBITDA has a major impact. We spoke about that question, that good question where would you rather have an increase in EBITDA? Would you rather have a $1 increase in EBITDA or a $1 increase in cash flow? And you'd usually always rather have a $1 increase in EBITDA because you get a multiple on that. So EBITDA growth is exceptional in terms of a driver. And then everything else that that generates unlevered free cash flow, right? And it depends on unlevered free cash flow. Deferred taxes, depreciation, working capital, CapEx, taxes is a variable. Is your cash, we talked yesterday about a quality of a good LBO is a company that has strong, steady, predictable cash flow. Is it still predictable? Finally, exit. What about the exit? Exit multiple, and what else? What else? What else about the exit? Something else. One more last key variable that you guys have forgotten. Important one.
Timeline?
Yes. Yes. Excellent. Time frame. And so if you think about this, and if you think about the stages of a deal, and if you think about the model that you build, this is the way you should be thinking about the progression of variables. The first unknown is, again, the valuation of the company and the purchase price I'm going to negotiate, my total obligations, and how I'm going to fund that. How I'm going to fund that and in what rate. And that's why usually a leverage buyout model that you build, the biggest variables are based on the purchase price and the debt equity ratio. And that's why we're going to start with building a two-variable data table based on the equity purchase premium and the debt equity funding sources. Right? It's always unknown with how am I going to establish a purchase price and how much debt am I going to get and at what rate. You know, so you want to look at, well, what room do I have to play with here, right? If my purchase price goes up to 50%, is that really going to kill my IRR? So in the beginning, you want a two-variable data table with at that time what the most major variables are, which is purchase price versus sources of debt. As that becomes known, as you negotiate with the lender, with the buyer, as you get more kind of comfortable with the purchase price, and that becomes more fixed. As you start negotiating with the lenders, and the lenders start to kind of hone in on, and you get a good idea as to how much debt you're going to raise, those numbers become fixed. Next, you start to build an operating model. Next, your model becomes more fixed on your actual projections. That's where the model will evolve from this type of model to one where your projected free cash flow evolves into one with an actual income statement, a cash flow statement, a balance sheet. And I'm going to show you after this an LBO model that we've closed that lays into that, right? And this is called an operating model. So if you guys are working out of funds, in the beginning you're building just a quick analysis to determine IRR, and then once you own the business, you want to build a core operating model, a strong income statement, cash flow balance sheet, to make sure you're hitting your EBITDA targets, honing on EBITDA growth. Are you achieving your cost-cutting goals? Are you managing your cash such that it is as strong and steady as it was predicted? So that's where this becomes a key portion of your model building. And then finally, what's always a mystery is, I mean, you always have a 5-year time frame, but it is honestly always a mystery when looking at when would I exit, when would I find a buyer, and what price would he pay? Time frame and exit multiple. And so that's kind of the ultimate. And that's why if you're building a robust full-scale model, you do want the model to be flexible by exit year. So actually now that we have it open, I want to show you quickly, and I'll show you a real analysis where this model is constructed to be flexible by exit year. Right? So how do you build the model, and we'll put a Dropbox in here, where you can have a variable such that if this is 2020 or if this is 2017, you know, my IRR analysis is going to change accordingly. And the reason why it's important to have one cell pointing to the variable for exit year is so that we can have a two-variable data table for exit year versus multiple. If a buyer comes in early, before my expected 5-year time frame, is it worth exiting? If he comes in later, if he comes in a different exit multiple, a lower exit multiple than planned, or a higher exit multiple than planned, is it worth exiting? And so that's why a good, strong, robust model will be flexible by exit year and by exit multiple. So we will talk about that. Further, it's important to think about key variables this way if you're thinking about a case. So what we'll do is once we complete the Hines model, we'll draw these key variables. We'll reiterate these key variables on the board, and we'll say, all right, let's hone down these key variables into the ones that actually matter. And noting, that 6 and 7 in a full-scale model, there's probably like 20 variables in there, right? Projecting other cash flow from operating activity items, right? Projecting non-occurring events, like all that stuff. Let's narrow those down to the ones that matter. So we're going to get on the board, and when we solve the case, we're going to say, all right, well, let's figure out what were all the key variables that we highlighted when building the case, and let's narrow it down to the ones that matter, and let's come up with a solution. Okay. Let's do the two-variable data table, and then I want to look at these variables and see how what impact these variables have on the IRR. Okay. So if you guys recall, if you don't, how to build a two-variable data table, the first thing you want is in the upper left corner of the table, you want a reference from the model that reflects what I want the table to be populated with. I want the table to be populated with varying IRR. To the right of that link, so I linked cell B53 in from C46. To the right of that, I want hard-coded one set of variables underneath a second set of variables. So to the right, 10, 20, 30, 40, 50, I want this to reflect my percentage equity. And remember, your model needs to be created so that the IRR is obviously dependent on that percentage and nothing else, or not nothing else, but such that if you change that percentage, it impacts your IRR. So in this case, if I change this to 20%, everything else moves with it, right? If these were all hard-coded, it wouldn't work, because if I lower this to 20%, then my total would be 90%, etc. And my IRR won't make sense. So this adjusting the equity variable does, in fact, drive the IRR. Underneath the 32.9%, I want this to be varying premium. Adjusting the premium will impact my IRR. And then to run the two-variable data table, I want to highlight everything. And I can do Alt-DT, Alt Data Table, or I can go up to the top, Data, What If Analysis, Data Table. And now it's going to ask for two inputs, the row input cell and the column input cell. And so the row input cell kind of says, all right, of these percentages across the row, 10, 20, 30, 40, 50, what the data table is saying, where do I go in the model to change that variable? So 10, 20, 30, 40, 50 is what? Who can answer that for me? Right. Nobody.
Equity.
Equity, thanks. Is H10. And then the column input cell is saying, of the percentages up and down the column, 10, 15, 20, 25, 30, where do I go in the model to adjust that? That's the purchase premium. I hit OK, and there we go. Right? So let's analyze this now. Okay. Number one, biggest variable, purchase price. As purchase price increases, actually coincidentally, our IRR is not dropping so significantly. Our premium could be 10%. Our premium could be 3 times as much. IRR only goes down by a few points. Important LBO interview question. Why? Why is my IRR not impacted as significantly when I'm increasing from 10% to 30% my purchase price? Think about it. Important. I want you guys to get it. Don't be shy. Robert suggested a relatively low share price. It is a relatively low share price, but whether it's low or high, if you increase it, let's say if I increase it by 50%, even by 50% across the board, it's dependent on something else. Who can come up with it? Anybody? Who can't come up with it? If anybody can't come up with it, speak up. Who can't come up with it and is embarrassed to admit it? Let me know. Okay. Robert. No, I'm just kidding. Okay. Jack left. I guess I scared him. Yes. Yeah, Robert. Go ahead.
Is it because the IRR is based on more our equity rather than the purchase price?
Not necessarily. But Brian, is that Brian? Brian, good. I like your thought process though, because that's going to be the next step. There's something else, and this has been asked in interviews, so this is an important component based on the mechanics of the LBO, based on the way we're setting the mechanics of the LBO. Why is it? I'm going to ask again. The impact of raising the price. Let's see if I make it 100%. It's not affecting the IRR that much. There's a very important key reason for that. Who gives up? Everybody. Okay. All right. If I was in class, I'd force it out of you. In person. Brian's sad. All right. I appreciate that though. The answer is because no matter what price we have, right, we are pushing the entry value out into the exit. I've seen guys get tricked with this in private equity interviews. In other words, whatever price I set is going to increase my entry multiple, which is going to increase my exit multiple. I set my exit multiple to be equal to my entry multiple. So I can pay a 30% premium, which is a 6.8 entry multiple, or I can pay 100% premium, and all that means is my entry multiple is 10.3%, my exit multiple is going up. This is one major flaw with just randomly assuming the exit multiple is equal to the entry multiple. I mentioned in class that that's conservative. It's not always conservative. If you're paying a ridiculously high price for the company, and then you're saying, well, my entry multiple is going to be equal to my exit multiple, you're just assuming that you're going to sell the company for a ridiculously high price. Might not always be the case. Heinz was acquired at a relatively high price. They were lucky to get that exit opportunity with Kraft. We'll look at that. One major flaw. If we had hard-coded the EBITDA multiple at like 6.8, I'm going to hard-code at 6.8. It's going to change everything. Hard-code 6.8. I would assume, okay, yep. So it changed. Now the percentage drops by 10 points, 10 percentage points. And if I make this 100%, it should go down even further. Yeah, it goes down 25%. Because at 100% rate, I could be paying a ridiculously high price, but I'm paying a ridiculously high price, 10.3, but I'm still selling it at the 6.8. So, important lesson to be learned. Just for formality here, and if you want to link the IRR in, and this is just so if you're putting together a pitch book, you can kind of cut and paste your assumptions into a slide and it has the output right there. Not so extremely important. Okay. Next, so important point there. Next, as equity increases, IRR dropped. Does that make sense? Anybody? More equity I put in, the lower my IRR. Does that make sense? Yes, no, maybe? Anybody? Yes.
Yes, it does, Paul.
Thanks, Jack. Okay, Jack came back. All right. Good. Yes. Why? Bigger piece of the pie. If you're paying more, right? Or the other way of thinking about it, the less equity that you put in, the more you convert that equity to debt, the more you can turn that into a higher exit. So this is the first way of looking at the impact that various variables have on the purchase price. One side note: if my entry and exit multiples are the same, why are these percentages going down at all? I made this back to normal where it starts at 6.8 and then drops just 2%. Why is it going down at all? Why is it not flat? What is impacting? Even though my exit multiple is equal to the entry multiple, 10%, 50%, 20%, this is a more difficult question than the first one. Why is my percentage points going down at all? Why is it not just the same? And part of the answer to that is that there's more to just the entry and exit purchase price that's impacting this. What is in fact causing a reduction? Yeah. Robert mentioned relatively low debt pay down. Can you clarify that? Because the speediness of paying down the debt the value of that is not really shown here without a debt schedule. So you're right in that the debt has a component to it, but it's not the debt pay down, it's what else? What instead? One more component. As the purchase price goes up, even though your exit value is going up equivalently, what else is going up? Anybody? The interest. Right? As your percentage is going up, you're paying more, you're raising more equity, you're raising more debt across the board, you're raising more debt, you're raising more interest expense. That goes to cash. You're absorbing the cash. Robert, maybe that's kind of what you were referring to in the end when you thought about the impact of that on cash, but I want to hone in on it's really because of the interest. Important to start thinking about things that way. Okay, yeah, okay. Robert said that he was thinking that, but it was too much to type that. Okay. Next, other things that impact these variables are net debt and fees, but those things are pretty much fixed, more or less. I mean, net debt, you'd either pay it down or not. You'd make that determination, and always conservatively, we would assume if it's unknown that we'd pay down the debt. You'd look it up on the balance sheet. It's not as much of a moving part. Fees also, 1-2%. We'll hone in on fees. It's not as variable as some of these other items, but it's important things to consider. Obviously, as net debt and fees increase, our total uses increase, and again, that means our debt and interest will increase. So the more of 2 and 3 that we have, the lower our IRR. Okay, so I'm just hitting in on how each of these key variables would impact our IRR. EBITDA growth, if EBITDA growth increases, obviously our IRR would go up. We can prove it because our exit will increase. And of course, as our unlevered free cash flow generation increases, our IRR would go up too. So just so you can solely understand how to break these things down and talk out in a case how these variables and adjusting these variables might impact or benefit the IRR. Time frame and exit, we can analyze this when we build the full model, but of course, as the exit multiple increases, so will our IRR. And if our time frame spreads out, how would that impact our IRR? What do you guys think? If the time frame increases, what do you guys think? Kind of a double-edged sword. Again, this is one I want to reiterate because this is a better one to debate in the classroom. It depends. It depends on what? Somebody wrote. It does depend. And this is better in class on Monday when we're in class to kind of go back and forth on this, and we'll reiterate this when we have the case. I mean, in one standpoint, an extra year could give you more cash debt pay down, which would be better. An extra year will give you more EBITDA growth, which would be better. However, knowing that, at the same time you're generating more interest, and what else? What's the other negative impact when looking at the way the IRR is calculated? Anybody? Yep. Why though, Daniel? So here's the IRR formula. Compounding, right? Over time, because of the nature of compounding, your IRR would effectively look lower even if you're given an extra year. And so this is where a lot of people actually are not, sometimes are against the actual IRR formula, because the IRR formula is a compounded interest, right? Sorry, is a compounded rate. It's 32.86% compounded each year. Some people like to look at a times multiple, money in versus money out. I don't care about 32% versus 25%, and we'll see this when we do the exit year versus multiple kind of formula, where if you extend out a year, that 32% might go down to 30%, and people think, oh, that's not as great a return. But you know what? But that's more money. It's more money. It's just less if you compound it, given the fact that you're compounding over 6 years versus 5. So a lot of people, for that reason, might think the IRR formula is misleading. And they'll look at a times multiple, money out versus money in, and I'm going to put the money in as a negative so I show positive. I'm getting a 4 times return. So some people would say, if I extend this out to 2019, this IRR might drop to 30%, but my 4.1 times return might go up to 4.5. People say, well, 30% might not be so great, but I'm getting 4.5 times my money back. So that's good. Okay, Daniel, the question. What happens when your first year is negative? Year 2 is positive. Year 3 is negative. No, the IRR formula will work if you put in money in here. We'll do this with the Heinz case to put in distributions if it's negative, positive, negative, positive. Or really, if you think about it, Daniel, it'll be negative here, positive here, negative here. As long as the sum of the cash flow ends up being positive, or really that the remainder of your final debt is positive, even if your remainder of your final debt is even if your cash is negative, it's just going to add to the debt. So as long as your exit is not negative, you will have an IRR. Let me just put it that way. So you could have cash flow swings, but if the sum of your cash flow, you just want to make sure that the sum of your cash flow is effectively paying down your debt, so that at the end you have less debt than exit, right? So in other words, let me illustrate this without drawing on the board. This is my exit, 33. Right? Where's my debt? My total debt obligation is, let's say it's 14, right? If my cash is negative, meaning I have more debt than cash, that's going to increase my debt balance, basically. Now, I'll still have an exit until my debt balance becomes so large that it's greater than my exit, right? If my debt balance is like 50 and my exit's 33, well, then that's bad, right? Because then I have 33 and I got to pay down 50 in debt and I got a negative return. Now I'm in trouble. So the cash swings don't make that much of a difference. I mean, it makes a difference, but if you see negative cash, that's not necessarily an alarm. But what is an alarm is if that negative cash brings your debt balance so high that suddenly your exit makes the deal not profitable. I'll put it that way. Any other questions on this key LBO? Okay, going to take a 10-minute break. I want to come back. I want to show you the deal that we're working on, and I want to do a couple of more kind of side private equity interview questions. So let's take a pause. Be back at 10:15.